So we're going to look at Abbott Laboratories, and you want to watch the whole video because I'm going to show you how to value a company. I'm going to take you through the process. What we're going to do is we're going to find their financials, we're going to put them into the model, and then we'll calculate the future free cash flows of the company. Then we'll figure out a discount rate to apply to those cash flows, and then we'll have an intrinsic stock price, and that will give us an idea whether the company is a buy or a sell. We'll also look at So Abbott Laboratories was founded in 1888 and it's located in Illinois, and they make medical devices. And right here you can see a picture of a medical device made by Abbott Laboratories, which is a testing kit for COVID-19. So let's get started in the model. And this is how an equity analyst values a company. They estimate the future free cash flows of the company and discount those dollar amounts. And first we're going to just get the market cap, which is 155.3 billion, because we need that in the model. And then the stock price is 87.78. Now we need to enter the actual free cash flows, and we can find that in Yahoo Finance under the cash flow section. And they calculate it for you in Yahoo. But if you look on a cash flow statement on a company's 10K, it doesn't have a free cash flow line. You have to calculate it yourself. So to calculate free cash flow, it's cash flow from operations minus capital expenditures. Next, we need the net income, which is the profit and loss. And that's on the income statement. I'll put that into the model. And it's important the numbers are positive and fairly consistent, else it's hard to value the company because we're using prior financial information. And if the information is spotty, then it just makes everything more difficult. So numbers look pretty good. They're all positive. So now we have the estimated future free cash flows. And that's the lifeblood of a company, the free cash flows, because you need cash to run your business.
Show me the money.
Show me the money! I need to feel you, Jerry! Show me the money! Jerry, you better yell! Show me the money!
Next, we're going to figure out the capital structure of the company. So we enter their interest expense, which is $670 million. That's how much they paid last year on their debt. And let's see how much debt they have. We'll go to the liabilities section. And the current debt is $1.5 billion. And the long-term debt is $16.5 billion. So they pay 3.7% on their debt. Interest payments are tax deductible, so let's get their effective tax rate. That's the hard thing with the income statement. There's a lot of non-cash items here, so the numbers aren't always as easy to follow year to year. So let's get the 2018 numbers. That looks more accurate. It seems like 2019, the effective tax rate is pretty low. So we want to get an accurate figure. So the 19% in taxes, that seems right. So the debt cost them 3% after the tax deduction. And they have 10% of the capital structure's debt, which is pretty good. They have a lot of room to borrow if need be. So let's get the beta. That's the volatility of the stock. And it's a pretty good beta, 0.97. That means the stock moves with the market. And then to calculate the weighted average cost of capital, it's a blend of the cost of equity and cost of debt. And that's 9%. And that's what we're going to use to discount the future cash flows. And we estimated future free cash flows for 4 years based on our inputs from earlier. We did a terminal value, which is all years past year 4. We discounted those numbers back to today's dollars. Then we get an intrinsic value of the company of $158 billion. And that gives us an intrinsic stock price of $90. And if you ask me,
I don't remember asking you a goddamn thing.